Speaking of Alternatives with Keshav Rajagopalan, Managing Director and Head of Product and Strategy at PGIM Multi-Asset Solutions. Insurance might not come to mind immediately as a key part of alternative investments, but it can play an important role within risk management and the optimal matching of long-term assets and liabilities. Keshav explores the world of reinsurance and asset management with Mike Thompson, Managing Director at Warburg Pincus and Head of Capital Solutions for Europe, and Nandini Mongia, Group Executive Chair and CEO of Prismic Life. This episode is only for listeners in the US. All investments involve risk, including the possible loss of capital. This podcast is for informational or educational purposes. The information is not intended as investment advice and is not a recommendation about managing or investing assets.
I'm really excited about today's conversation where we're going to explore reinsurance. Our last episode focused on portfolio construction and the use of alternatives, and we started touching on a very interesting trend in the marketplace, which is what sits at the nexus of insurance and asset management. And today I'm joined by two friends and two colleagues. We have Nandini Mongia, who's the Group Chair and CEO of Prismic Life, and Mike Thompson, a Managing Director at Warburg Pincus. Nandini, to start us off, share a little bit about your story. What has brought you to insurance and now reinsurance, and what excites you about what we're doing today?
Thanks, Keshav. I have spent well over 2 decades, actually almost close to 3 at this point, working in a number of finance-related roles, and then most recently business management-related roles around the insurance and then reinsurance industry broadly defined. I worked in investment banking for about 15 years and then joined Prudential, where I was for about 8 years prior to joining Prismic. I joined Prudential as CFO for the retirement business. I was then treasurer for Prudential before leading what was called the Open Architecture Solutions business, where I oversaw Prudential's fully owned as well as sponsored reinsurance entities. And I've actually been involved in the design and concept of the Prismic platform from the very early days and its development as well.
Thanks, Nandini. And Mike, we've now partnered together for a couple of years as we've jointly worked on starting Prismic, and we'll share a little bit about that story. But you're a managing director at Warburg and sit in the capital solutions business. But tell us your story about coming into the investment space and what you're doing at Warburg today.
Sure. I started my career in banking, spending time in leveraged finance and M&A at Merrill Lynch. I've now been making private investments for over 20 years. I'm the head of capital solutions here in Europe since 2019. And before that, I spent almost 15 years at Sculptor in the private investments group, always investing in the alternative space with a big bent towards financials and insurance. And to the very here and now, as you said, Keshav, we have been working on this a while. I went back and looked. It's almost exactly 4 years to the day that we all met on the Prismic project. Some days it feels like longer.
That's what's made this fun and interesting. So as I mentioned, reinsurance, not always the most interesting of topics, but it's an interesting space. I often joke with my friends that insurance is now, we're the cool kids on the block. But Nandini, what is reinsurance? Because I think a lot of folks probably have heard the term, but what is it? Simplify it for us on how you think about it in the context of Prismic.
Certainly. We do think reinsurance is cool. I don't know whether that makes us cool kids or not. But reinsurance in its most basic form is really the transfer of risk from an insurance company to a reinsurance company. So you can think of it as insurance for insurance companies. What does it do? Why should insurance companies actually buy insurance for themselves? It breaks down into 3 simple reasons. The first is to manage their risks, for insurance companies to keep what they want on their balance sheet and then move risks that they don't want to retain. The second is financial protection. So insurance companies can shape the profile of the earnings and the capital and manage their own volatility. And the third really important reason is to enable growth, to release capital that they can then redeploy for desired growth elsewhere. If I take it up a level, at the highest level, you can ask the question and say, who does reinsurance actually serve? That's a natural question. And at the highest level, you could say society at large. The reason I say that is because just as insurance is really a social good, meaning it helps ensure that our society actually functions right by managing and mitigating risk that individuals or companies cannot bear. Similarly, reinsurance companies actually play a pretty vital role as well by bringing capital and solutions to enable insurance companies to fulfill their role as a social good.
You've simplified it for us. Now, talk to us about Prismic. What is Prismic and how does it play a role in that reinsurance context?
Prismic is a global reinsurance platform that benefits from very strong sponsorship by Prudential and PGIM and Warburg Pincus's market-leading asset management franchises. Prismic Life, from the get-go, has been developed with expertise and the expectation of operational scalability, meaning the ability for it to grow in a scalable and sound manner so that we can provide risk and balance sheet management solutions. Prismic has been designed from the start to have balance and diversification. So on the liability side, diversification meaning long duration liabilities and short duration liabilities, global diversification, US and Japan, for example, and different types of risks as well. And then on the asset side, diversified strategic asset allocation that is fit for purpose for the liabilities. When you put it together, Prismic has the ability as a private reinsurance company to look to the underlying risks and the long-term economics of the liabilities that we are taking on from our clients.
As you mentioned, Prismic is a partnership. And Mike, coming to you, you've been investing in this space now for many years, and Warburg is about to turn 60. So it's a very, very storied private equity firm. What brought you into the Prismic partnership? And also maybe touch on that trend of insurance and asset management coming together and how Warburg is thinking about the partnership around it.
At its basics, a successful private equity investment really has three things. It has, first, an attractive entry point on price. Second is secular growth trends. And the third is value creation opportunities. And insurance and reinsurance is actually at a pretty exciting point right now on all three. On the point around entry pricing, public markets really don't like balance sheet heavy financials companies. And as a result, don't value them anything like where they should be. You have most of the sector trades below book or intrinsic value. When you've got such cash flows, public markets issue them. As to the second point, which is secular growth trends, this is actually also exciting because in the US, UK, and Europe, you have gargantuan mega trend of, in particular, the pension risk transfer market, where you're seeing trillions of dollars in US, UK, and continental Europe transferring from corporate balance sheets to insurance companies, the result of which is enormous capital flow requiring enormous private capital, because public markets, as I said, very hard to access additional capital. And that's a global megatrend that has a capital demand that can't be fulfilled by the public markets alone.
Public capital markets have an important role to play, as all investors are aware, but private markets can offer additional benefits, which can be particularly well suited to insurance companies, matching their long-dated liabilities.
The second global trend, which goes to the value creation, is the rise of alternatives, and especially private investments. Insurers in general were slow to embrace alternatives, and especially privates, and that's despite their long-dated liabilities being incredibly well-suited to benefiting from the liquidity premium that such investments offer. The result is that the average insurance company, historically, has had a relatively unsophisticated and unoptimized asset allocation, and so are leaving investment spread on the table. Alternatives and private investments enable greater optimization through bespoke structuring of cash flows to better meet the needs of the insurance liabilities, enable better pricing for policyholders, and greater profitability per unit of capital. If you layer those three ingredients together, we think the global megatrend, the unoptimized balance sheets, and the opportunity to provide capital into a market where public markets have struggled, we think there's really compelling ingredients for attractive investment. In bringing that to Prismic, what we saw in Prismic was an ability to partner with one of the leading insurance liability distribution businesses in the world, Prudential, one of the leading fixed income managers in PGIM, and of course, Warburg's investment prowess in private equity, supplemented by our collective ability to build and grow sustainable and enduring large companies.
Mike, I think you hit it on the head. That is the partnership, right, between Pru's liability origination machine, PGIM's credit capabilities, and Warburg's private equity. And as you mentioned, it's that nexus of bringing private capital into the space, but then also supporting the investment engine of a balance sheet like Prismic with these world-class capabilities. And I think, Nandini, coming to you, as you think about the Prismic journey 3-5 years from now, where are you headed? What excites you about where this is going and amongst the backdrop of what's happening in the insurance space overall?
As Mike said, when you look at global mega trends, the balance sheet of the insurance industry as it exists today is actually not sufficient to support what we'd call global unmet insurance and retirement income needs. Our vision when we look 5 years out, 10 years out, is for Prismic to be a strategic reinsurance partner, first to Prudential, and then in time to a broader set of clients where we are bringing capital to the industry and solutions to enable our clients' growth and balance sheet management objectives. We see Prismic sitting at the nexus of bringing that capital to the industry and then providing solutions to our clients with a range of risk-reward appetite to fit the very broad range of client needs and solutions.
And Mike, Warburg was an investor in Prismic alongside Pru. And what is the thesis? You run the capital solutions business for Warburg in Europe. You're seeing a lot of these types of investments around the world. What is the investor thesis and what makes that return profile interesting and compelling?
It's actually a remarkably simple business model, which is we take very long duration liabilities, very stable, very predictable. We match them with very long dated, ideally matched asset allocation, taking advantage of the illiquidity premium that I mentioned earlier, using the illiquidity that's inherent in those liabilities to match them and provide a levered spread between the cost of liabilities and the yield on the assets. What we really like is just the long-dated, predictable nature of the return. This is purely an economic model. It's very attractive to match long-dated, stable liabilities with locked-in asset yields, generate a spread, and generate strong distributable earnings over a long period of time.
As institutional investors, insurance companies may be well suited to private markets because of the long-term nature of their liabilities and their ability to tap into the illiquidity premium that comes with private investments.
Every episode, we like to unpack a headline, and this one's a little bit more dated, but it had a nice strategic overlay, which was an article McKinsey published focusing on an interview with Anand Bala, who's well known in the insurance and reinsurance space. He focused on this strategic trend underway of private alternatives in that insurance space, which, Mike, to your point, is what's different about the insurance space today as you think about the evolution of asset allocations. We touched on this a little bit on the last episode about how private alternatives in asset allocation are playing a more prominent role. Nandini, from your seat, as you think about Prismic's balance sheet, what is it that attracts your CIO, your CFO in terms of the use of alternatives, private equity, private credit, and how that mixes into the goals Prismic has in terms of out-yielding the liability, but then also generating an attractive return?
This is the insurance industry business model by its very nature. The benefit of making decade-long promises, either to help policyholders manage the risk of dying too soon or living too long, and then have those long-dated promises be suitably matched with assets that can be invested for a similar time horizon. As an example, for really long duration promises that are made to policyholders, the ability to actually look at that long duration and then make suitable investments in alternative assets, such as private equity and private credit, to be able to compound investment returns, to be able to meet those promises and defease them, is fundamentally the premise of the insurance industry. So what Mike referred to when he talked about liquidity is just that. The funding, as it's called, that insurance companies receive by way of the premium that we get from our insurance company clients, that we have to responsibly hold and invest to be able to deliver on the guaranteed return that we have promised to our clients. And insurance companies, as I said, are really best suited as the business model of choice to do this. You could argue to the other extreme of it would be banks that actually have very short-dated funding and are actually not very well suited to take that deposit-like short-dated funding and go out and make very long-dated investments. So as you see some of that investment move from hands where did not actually have the long-dated funding into insurance companies, it's really for that reason. It's the fundamental concept and sound principles of asset liability management and matching.
Yeah, what Anand did well in that article was to introduce the banking alternative. I suppose for listeners who I'm sure understand this, but it's worth recapping. The core conceit of banking is to take short-dated deposits, often available to withdraw at any time, and then through liquidity transformation, make them available for long-term loans. And as we saw in the financial crisis and again in the 2022 regional banking crisis, that core conceit has a liquidity mismatch that can cause detriment to society at large and the economy through bank runs in an extreme scenario. And I think what became obvious is that the long-dated nature of the liabilities in insurance and the manner in which they're not runnable in the same way as deposits makes them much more able to take those illiquid assets and therefore earn that illiquid premium and the excess spread.
You both said it so well and framed it. I think that's what is happening. And it's changing capital markets, but allowing capital markets to really think about investing for the long term. Because as you both pointed out, with banks, there's just an inherent mismatch. And the ability to invest through the cycle long term is really the foundation of capital markets. And that's what I think insurance liabilities allow you to do best. And I think that is what Prismic is harnessing. And to me, the next layer of it, this podcast is focused on alternatives. So we're focused on how alternatives are playing a role in capital markets. But Prismic in and of itself then is an alternative. It's exposure to a wide array and diverse allocation of alternatives. And that's what I think is so compelling about how it's also affecting capital markets.
Regulatory agencies play an indispensable role in providing stability and balancing the protection of all industry stakeholders. This can benefit both the providers and consumers of financial services. This is certainly true within the nexus of insurance and asset management.
We like to also ask our client-facing teams what they're hearing. And insurance, again, not always the most exciting of topics, but it's actually getting a lot of play. The first question I asked Nandini to you is, regulation is always something that's talked about, right? It's a financial services industry. It is a regulated industry. What are some of the things you're hearing? You're calling in from Bermuda today, where there's a growing focus of insurance there, but a very thoughtful regulatory approach and regulatory framework. So how are you engaging with regulators, and what are you hearing from them in terms of what's important to make sure that this remains a prudently approached industry?
Keshav, you said it really well, which is the use of the word prudent. Regulators actually play a vitally important role in our industry in ensuring prudent supervision and policyholder protection as one of their twin mandates. The second, which is equally important, is the role that regulators play in allowing access for policyholders to have the ability to meet unmet risk protection needs from dying too soon or living too long. Our experience with regulators in our very active engagement with them is they appreciate and understand the importance that prudential supervision plays in our industry for both those mandates.
And Mike, in that vein, industry is regulated, but a heightened focus is on private alternatives and specifically private equity that is part of the industry landscape now. We talked about the importance of it, especially as you think about the investment for the long term. But what are some of the things that you're focused on or Warburg is focused on in terms of how this insurance asset management nexus is coming together and the role of private equity in it?
Let's recap on private equity's involvement in the sector. In the first phase, private equity bought legacy insurance companies very cheaply at steep discounts to their inherent value because they were trading on the public markets below book value, and was focused on effectively just realizing that discount through running off the liabilities and capturing the surplus. In the second phase, they invested in or built insurers and reinsurers to write new policies to grow the assets and liabilities and attractive locked-in yields. That was as they got more comfortable with the business model and the use of alternatives to enhance the asset yield. The most recent evolution we've seen is insurers themselves investing in alternative asset managers, sort of like a reverse Pac-Man, so as to buy the alternative capability in-house. And you often see them subsequently outsourcing a chunk of asset management. There was a recent very large deal done by a prominent mutual in this space where we saw them take a significant minority investment in a large alternative asset manager and then subsequently deploy a number of their assets with that same investment manager. I think that's a trend we'll see continuing over the next few years, as incumbent insurers have no choice but to either develop in-house their alternative asset management capabilities or rent it or buy it.
Mike, we covered this in the last episode a little bit, but that is actually what's at the genesis of, I think, this exciting change in capital markets and in the insurance industry. Nandini, it comes back to your point on the prudent supervision, right? And at the basis of it is proper asset liability management, because you want to invest assets according to the liability profile that you're trying to outyield.
That's right. It's about getting the balance between prudent principles-based supervision and regulation that has appropriate safeguards in place to be able to write business that is more closely aligned to the underlying economics, and that allows insurance companies and reinsurance company business models to be managed in a prudent way to be able to serve their clients, protect policyholders, as well as provide new solutions into the industry.
I think, Nandini, you framed it well, taking the two poles, and ultimately it's about that balance. Mike, you hit on this as well. There's an unmet need out there that society has, just given demographic changes and retirement security, financial wellness that are kind of underpinning the importance of this. And then, Mike, I think you hit on the role of a firm like Warburg is to also create value at the company level to then allow it to meet its objectives.
Yeah, absolutely. I'd almost say it even more simplistically. We start with the liability cash flows. They determine the asset allocation. Only assets that are appropriate for the liabilities are chosen. Regulatory concerns on top, we almost view those as a great positive because they provide a barrier to entry and provide discipline and capital optimization. And those things are great for a healthy, sustainable insurance industry. In terms of the opportunity for further growth, as we highlighted at the top of the call, this is an industry with an almost infinite capital need, and private equity exists to fulfill capital needs. So for as long as there is attractive level returns, we will be gladly supporting this industry.
You framed it well. Well, Mike, Nandini, thanks so much for the conversation today. Just always an interesting one on these podcasts, but this one was especially exciting for me, just being able to do it with friends and close colleagues. Three things that stood out to me from our conversation. One is just how exciting this space is right now. There's so much happening at the nexus of insurance and asset management. And as I mentioned at the beginning, we are the cool kids on the block now. There's just a lot that's happening, a lot of capital market impacts and trends underway in a space that I think we'll all be watching very closely. Two is when you think about insurance asset management, it really comes down to prudent ALM. Knowing what assets need to match your liabilities underpins everything in terms of the strategy and the asset allocation you need to take. And three is this is really about investing for the long term. The role of private alternatives in insurance asset management, underpinning that is the thesis of being able to look through the cycle, invest for the long term. And that really is the foundation for our capital markets. Thank you both again for the time today, and very excited about our next episode where we'll be talking all things industrial Mexico real estate on Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajakapalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.